All right, let's dive into a very important and contemporary topic in our auditing curriculum: sustainable development and a framework of ESG. Now, to start with, the concept of sustainable development actually traces its roots back to the Brundtland Report. If you look at the definition provided, it's quite simple yet profound. Sustainable development is all about meeting the needs of the present generation without compromising the ability of future generations to meet their own needs. In a business context, this means we cannot just focus on short-term profits. We must ensure that our growth doesn't destroy the world for those who come after us.
To put this into practice, the corporate world uses a framework known as ESG. You'll see this term everywhere in the industry today. ESG stands for environment, social, and governance. Let's break these three pillars down so you can understand them clearly.
First, we have the environment, represented by the E. This is all about the entity's impact on the planet. Think about the natural resources a company absorbs to function, things like coal, electricity, and water. But it's not just about what goes in. It's also about what comes out. We're talking about carbon emissions, water discharges, and e-waste. Essentially, the E focuses on climate policies, pollution control, and the conservation of natural resources.
Next, we move to the social pillar, the S. This is centered on people. It's about the relationships a company builds and the reputation it maintains within the communities where it operates. This includes the entire value chain. When you're studying this, think about labor relations, diversity, and inclusion. A company doesn't exist in a vacuum. It operates within a diverse society, and how it treats its people and the community is a core part of its sustainability.
Finally, we have governance, the G. Since every company is a legal creation, it needs a system to run itself. Governance refers to the internal practices, controls, and procedures an entity adopts. This ensures the company makes effective investment decisions, complies with the law, and meets the needs of all its stakeholders. It's the structural backbone that ensures the company is run ethically and transparently.
So just remember, environment is about the planet, social is about the people, and governance is about the process. Together, these three pillars form the foundation of ESG.
All right, let's dive into the core of ESG reporting. When we talk about environmental, social, and governance or ESG, we are essentially talking about how a company discloses information, data, and metrics that demonstrate the value it adds in these three critical areas.
Now, as a CA final student, it's important to understand that ESG reporting isn't just one size fits all. It can be qualitative, where the company describes its strategies and policies, or it can be quantitative, using specific metrics and key performance indicators or KPI to measure actual progress against their goals. In practice, the most effective disclosures use a mixed approach, combining both the how and the how much to provide a complete picture.
First, we have the environment pillar. This is divided into four main areas. We look at climate change, which involves tracking carbon emissions, product carbon footprints, and how the company manages climate vulnerability. Then there are natural resources, focusing on water stress, biodiversity, and where raw materials are sourced. We also track pollution and waste, specifically toxic emissions, packaging waste, and e-waste. Finally, there's the environment opportunity side, where companies highlight their investments in clean tech, green buildings, and renewable energy.
All right, let's dive into the critical area of sustainable development goals and ESG assurance. Now, as we move toward a more sustainable economy, the reporting of environmental, social, and governance factors, or ESG, is becoming incredibly important. But remember, reporting is only as good as its reliability. That is why assurance in this space is now absolutely critical.
Think of an ESG audit as a comprehensive process. It's not just about ticking boxes. It's about helping a company evaluate the environmental and social risks associated with its products, services, and overall operations. Beyond the internal operations, conducting an ESG audit allows a business to scrutinize its supply chain risks, strengthen its risk management capabilities, and, most importantly, ensure transparency with its shareholders.
To bring structure to this, the ICAI has introduced the Standard on Sustainability Assurance Engagements, known as SC3000. You can think of SC3000 as an umbrella standard. It applies to all assurance engagements regarding sustainability information, whether the auditor is providing reasonable assurance or limited assurance.
Who is this standard for? It's designed for three main groups: the assurance providers themselves, the entities looking to hire a professional auditor, and the external stakeholders like regulators and investors who rely on this sustainability data. Now, pay close attention to the timelines here for your exams. SC3000 was available on a voluntary basis for reports ending March 31st, 2023, but it becomes mandatory for assurance reports covering periods ending on or after March 31st, 2024.
Additionally, keep SAE 3410 on your radar. This standard specifically deals with greenhouse gas statements and includes the Assurance of Business Responsibility and Sustainability Reporting, or BRSR.
Finally, let's look at the actual methodology for providing assurance on a BRSR. It follows a logical flow. It starts with a preliminary review of the ESG report and its parameters. Then we move into the on-site assessment and verification phase. This is followed by a review of responses and clarifications regarding any findings. Once that's settled, the auditor submits the findings from the on-site assessment and document review. This leads to the preparation of the assessment or verification report, which includes the final results and recommendations. The process concludes with the formal issuance of the assessment report and assessment statement.
Now, let's dive into a very contemporary and important area of our syllabus, social audit standards. As you know, the focus of auditing is shifting from just financial numbers to the actual impact an organization has on society. To bring structure to this, the Sustainability Reporting Standards Board of the ICAI has issued the Social Audit Standards, ranging from SAS 100 all the way to SAS 1600.
Think of these standards as a guidebook for the social auditor. Their primary goal is to provide the necessary guidance for conducting independent impact assessment engagements. When a social enterprise is working in a specific area, the auditor needs to know exactly which steps and procedures to apply to measure that impact accurately. It is important to remember that these SASs set out the minimum requirements. If there are specific laws or regulations that demand more detailed reporting or different procedures, those additional requirements must also be followed.
For instance, we have the basic human needs covered in SAS 100, which deals with eradicating hunger, poverty, and malnutrition, and SAS 200, which focuses on healthcare, mental health, and safe drinking water. Then we move into human development. SAS 300 is all about education and livelihoods, while SAS 400 focuses on gender equality and the empowerment of women and LGBTQ+ communities.
Environmental and cultural preservation are also key. SAS 500 is a big one, covering environmental sustainability, climate change, and wildlife conservation. SAS 600 protects our national heritage, art, and culture. The standards also cover specialized areas of growth. SAS 700 focuses on promoting sports, from rural levels up to the Olympics. SAS 800 and 900 are about the ecosystem itself, supporting incubators for social enterprises and strengthening nonprofit fundraising and capacity building.
Next, we move to the social pillar. This is all about people and impact. We look at human capital, which covers labor management, health and safety, and supply chain standards. Then we have product liability, ensuring that products are safe, chemicals are handled correctly, and data privacy is maintained. We also consider stakeholder opposition, such as controversial sourcing. And just like with the environment, there are social opportunities, such as improving access to communication, finance, and healthcare. As we look at the higher numbers, we see a focus on marginalized sections. SAS 1000 deals with the rural and urban poor and small farmers. SAS 1100 focuses on slum development and affordable housing to build resilient cities. SAS 1200 is dedicated to disaster management, including relief and reconstruction. Finally, we have the modern challenges. SAS 1300 is about financial inclusion. SAS 1400 helps disadvantaged communities access land and property. SAS 1500 addresses the digital divide and data protection. And SAS 1600 focuses on the welfare of migrants and displaced persons. It's a wide-ranging framework, but the core objective remains the same, ensuring that the social claims made by an enterprise are backed by a rigorous, standardized impact assessment.
First, let's ground ourselves in the basics. As auditors, our primary objective remains the same. We are here to obtain reasonable assurance that the financial statements are free from material misstatement, whether that's due to fraud or error. Our goal is to report whether these statements are presented fairly and in accordance with the applicable financial reporting framework. However, the modern landscape is changing. When you are developing your understanding of an entity, which is a fundamental step in any audit, you must now explicitly include the consideration of climate-related risks.
Now, keep in mind that climate risk isn't uniform across all businesses. It's significantly more relevant in certain sectors. Think about banks and insurance companies dealing with climate-related assets, or industries like energy, transportation, agriculture, forestry, and materials and buildings. These sectors are on the front lines of environmental change and regulatory shifts.
Because of this, there is a growing demand from investors and stakeholders. They are looking at the auditor's report to see how these climate-related risks were addressed. You will likely feel increasing pressure for more transparency in your reporting. But here is the golden rule. While we want to be transparent, the auditor's report must strictly follow the requirements of the applicable auditing standards. We cannot simply add information that doesn't fit the standard. So, how do we actually communicate this? The auditor's report is our key mechanism.
Beyond the audit opinion, it outlines our responsibilities and, where required, explains the most significant matters of the audit and how we handled them. In certain cases, if a climate-related disclosure is of fundamental importance to the user's understanding of the financial statements, you might consider including an emphasis of matter paragraph to draw the reader's attention to it. Before you even touch the auditor's report, though, you must determine if the entity has appropriately disclosed this climate-related information within the financial statements themselves, following frameworks like the Indian Accounting Standards.
Finally, don't forget the other information. Under SA 720 and ISA 720, you are required to read other public communications like management narratives in the annual report, press releases, or investor updates to ensure they are consistent with the information disclosed in the audited financial statements. This ensures there are no contradictory, claims being made about the company's climate risks to the public versus what is recorded in the books.
Now, let's dive into this critical case study from the Advanced Auditing and Professional Ethics module. This scenario is a perfect illustration of how ESG environment, social, and governance factors directly impact business strategy and audit risk. First, let's set the scene. We are looking at the agrochemical sector in India, a massive $35 billion industry. While this sector is vital for crop yield and export growth, it comes with significant risks. The text highlights a major tension: the push for higher yields versus the adverse effects of toxicity on humans, animals, and the environment.
Pay close attention to the regulatory framework mentioned here. The Central Insecticide Board, or CIB, uses a color-coded labeling system to categorize toxicity. Red is the most toxic and green is the least. A key point for your exams is the regulatory gap. Many red-labeled products are banned globally, but still sold in India because the local regulatory environment isn't yet stringent enough. We also see a massive issue with counterfeit products, roughly 25% of the market, which creates a huge reputational risk for legitimate companies.
Now, the core of the case study compares two different corporate philosophies through Company A and Company B. Both are top 1,000 listed companies, but their approaches to sustainability are polar opposites.
Company A is taking a proactive, ESG-centric approach. They aren't just waiting for the law to change, they are anticipating it. In December 2023, Company A made the bold move to eliminate red-labeled products and even discontinued yellow-labeled ones. They are shifting their focus toward R&D and investing in back-end systems for unique, user-friendly labeling to fight counterfeiting and improve transparency for multilingual consumers. Essentially, Company A is prioritizing long-term sustainability over short-term gains. Finally, we have governance. This is the backbone of the organization. It covers corporate governance elements like board diversity, executive pay, and ownership structures. It also delves into corporate behavior, business ethics, and the fight against corruption and anti-competitive practices. We also look at financial system stability and, very importantly for us as auditors, tax transparency.
On the other side, we have Company B. Company B is focused purely on traditional financial metrics, revenue, and profit growth. To give you an idea of the risk they are carrying, 14% of their top-selling products are derived from those high-toxicity red and yellow labels.
As we move forward, keep in mind that this contrast sets the stage for how an auditor would view these two entities. One is mitigating future regulatory risk, while the other is potentially exposing itself to significant legal and operational liabilities.
First, look at Company A. They took a proactive approach by phasing out toxic products. Yes, it hurt the revenue by 8% initially, but look at the long-term play here. Because they acted early, they've essentially future-proofed their business. As regulations get stricter, Company A is already compliant, meaning they won't face the sudden shocks or heavy penalties that lagging companies will.
Now, contrast that with Company B. They are seeing a 9% growth in revenue, which looks great on a balance sheet today, but it's coming from a red-labeled insecticide, DDT. This is a huge red flag. The fact that regulatory authorities are already investigating them and demanding additional tests suggests that Company B is sitting on a ticking time bomb of regulatory risk.
So, if you're answering the questions posed in the text, for reporting requirements, Company A will report its transition and the resulting impact on revenue, while Company B must disclose the contingent liabilities and the risks associated with the ongoing regulatory investigation. Company A is the one that has absorbed the impact of future changes by taking a hit now to ensure long-term survival. For the auditors, this is critical. The auditor of Company A will focus on whether the revenue decline is accurately reflected, but the auditor of Company B must be extremely cautious about going concern assumptions and whether the potential regulatory crackdown could lead to massive fines or the banning of their primary product.
Moving into the conclusion of this chapter, the big takeaway is that sustainability reporting is gaining massive global momentum. However, the challenge is that we don't have a common language or a single uniform set of standards yet. As companies move towards sustainability-branded reporting, the demand for independent assurance is skyrocketing. As future CAs, you need to realize that your role is expanding. You aren't just auditing numbers, but also the integrity of ESG claims.
To wrap up the key takeaways, remember that sustainable development is all about meeting present needs without compromising the ability of future generations to meet theirs. ESG stands for environmental, social, and governance. These are the three pillars of reporting, and this reporting can be both quantitative like carbon emissions data and qualitative, such as descriptions of the company's social impact policies. Now, let's dive into a very important and contemporary topic, Sustainable Development Goals, or SDG. As future chartered accountants, it's crucial to understand that the business world is moving beyond just financial profits toward a more holistic approach to value creation. Back in 2015, all United Nations member states adopted a comprehensive blueprint known as the Sustainable Development Goals. Think of these SDGs as an urgent global call to action. It doesn't matter if a country is developed or developing, the goal is universal.
The core philosophy here is that we cannot tackle poverty in isolation. To truly make a difference, ending poverty and deprivation must happen simultaneously with strategies that improve health and education, reduce inequality, and stimulate economic growth. And all of this must be achieved while we actively fight climate change and protect our natural resources, like our oceans and forests.
Keep this momentum going. The UN has a dedicated body called the Division for Sustainable Development Goals, or DSDG. This division provides the necessary support and capacity building across various critical themes, everything from water and energy to urbanization, science, and technology. They are essentially the engine driving the 2030 agenda, ensuring that these goals aren't just words on paper, but are translated into real-world action through the commitment of all stakeholders.
Now, you should be familiar with the 17 specific SDGs. You don't need to memorize them word for word, but you should understand the breadth of what they cover. They range from basic human needs like no poverty, zero hunger, and quality education to social equity, such as gender equality and reduced inequalities. They also cover environmental stewardship through goals like clean water and sanitation, affordable and clean energy, climate action, and the protection of life below water and on land. Finally, they address the structural side of things with goals for decent work, industry and innovation, sustainable cities, responsible consumption, and the creation of peace, justice, and strong institutions, all tied together by partnerships for the goals.
Keep these 17 goals in mind, as they form the foundation for the sustainability reporting and assurance frameworks we will discuss next. First, you need to understand who is actually required to report. Generally, mandatory reporting is aimed at the public sector, government-run companies, large corporations, multinational conglomerates, and listed companies.
Now let's dive into the global trends in sustainable reporting. This is a crucial area for your CA final exams because the world is shifting from purely financial reporting to a more holistic approach. First, you need to understand who is actually required to report. Generally, mandatory reporting is aimed at the public sector, government-run companies, large corporations, multinational conglomerates, and listed companies. We are also seeing a rise in sector-specific and thematic reporting, meaning certain industries might have unique requirements based on their environmental impact.
When it comes to the frameworks used, there are three major ones you must remember. First, we have the Global Reporting Initiative, or GRI. This is the heavy weight in the room. It's the most widely used framework globally, with 93% of the world's largest 250 corporations using it. Based in Amsterdam with hubs worldwide, including India, GRI is designed for the public interest. It helps organizations report on three core pillars: economic, environmental, and social impacts. The key takeaway here is that GRI reports are addressed to all stakeholders, not just investors.
Second is the Carbon Disclosure Project, known as CDP. While GRI is broad, CDP is laser-focused on environmental performance. It specifically captures data on greenhouse gas emissions, water, forests, and supply chain management. If you see a question focusing on climate change or water security, think CDP. This report is primarily aimed at investors, buyers, and other stakeholders. Third, we have the International Integrated Reporting Framework, or IRC. The goal here is integration. Instead of having a separate sustainability report, the IRC provides principles to create an integrated report. This combines the organizational overview, governance structure, business model, risks, opportunities, and strategy into one cohesive narrative.
Now, here is a very important development for your conceptual understanding. In September 2020, these various framework and standard-setting institutions decided to collaborate. They realized that having too many different standards was confusing. Their goal was to provide joint market guidance on how these frameworks could be used complementarily. Essentially, they wanted to create a bridge between these sustainability standards and the traditional financial gap, moving us toward a more coherent and comprehensive corporate reporting system. This collaboration also included a joint commitment to drive toward this goal through a program of deeper collaboration between 5 key institutions and a willingness to engage with other interested stakeholders.
Now let's dive into a very contemporary and critical area of our syllabus, the evolving landscape of sustainability and SG reporting. As future chartered accountants, you need to understand that the world is moving beyond just financial numbers. Investors today are demanding high quality, transparent, and comparable information regarding environmental, social, and governance or SG matters.
In November 2021, the IFES Foundation trustees took a monumental step by announcing the creation of the International Sustainability Standards Board, known as the ISSB. The core objective here is simple yet powerful. The ISSB aims to deliver a comprehensive global baseline of sustainability-related disclosure standards. This ensures that investors and capital market participants have the necessary information about a company's sustainability-related risks and opportunities to make truly informed decisions.
Back in March 2022, the International Sustainability Standards Board, or the ISSB, launched a consultation on 2 pivotal proposed standards. One focuses specifically on climate-related disclosures, and the other on general sustainability-related disclosures. Once these are finalized, they will serve as a comprehensive global baseline. They actually build upon the recommendations of the TCFD, the Task Force on Climate-Related Financial Disclosures, and they incorporate industry-specific requirements derived from the SASB standards.
First, we have the TCFD, or the Task Force on Climate-Related Financial Disclosures. Created in 2015 by the Financial Stability Board, The TCFD focuses specifically on helping companies create consistent climate-related disclosures. A key distinction to remember for your exams is that while something like the GRI works across a wide range of organizations, the TCFD is more targeted toward entities handling financial interests, such as banks and insurance firms.
Then we have the CDSB, the Climate Disclosure Standards Board. This group was committed to integrating climate-related disclosures into mainstream corporate reporting and provided a framework for reporting environmental information. In fact, the ISP has actually adopted the technical guidance from the CDSB to develop the IFD Sustainability Disclosure Standards. We also see the Value Reporting Foundation, or VRF, which was born from the merger of the SASP Foundation and the International Integrated Reporting Council.
Finally, it is crucial to note the synergy between the boards. The International Accounting Standards Board, which handles our traditional financial standards, and the ISP have agreed to work together to build an integrated reporting framework. This ensures that financial and sustainability reporting aren't treated as separate silos, but as a unified picture of a company's value.
Back in March 2022, the International Sustainability Standards Board, or the ISP, launched a consultation on two pivotal proposed standards. One focuses specifically on climate-related disclosures, and the other on general sustainability-related disclosures. Once these are finalized, they will serve as a comprehensive global baseline. Why is this important? Because it's designed specifically to meet the information needs of investors who are trying to assess the true enterprise value of a company.
Now, let's look at IFRS S1 and S2. The requirements in the exposure draft for IFRS S2, which deals with climate-related disclosures, aren't created in a vacuum. They actually build upon the recommendations of the TCFD, the Task Force on Climate-Related Financial Disclosures, and they incorporate industry-specific requirements derived from the SASB standards.
To put this into a real-world perspective, imagine you've just cleared your CA final exams and joined a listed company. Even if your company isn't in the top 1,000 listed firms, they might decide to voluntarily include sustainability reporting in their annual report using the Global Reporting Initiative, or GRI, framework. If you're assigned to collate this information, you need to understand that sustainability reporting is more than just a buzzword. It's about disclosing how a company manages its impact on the environment, society, and governance. The benefits are huge. It improves transparency, builds trust with stakeholders, and helps the company manage long-term risks.
Moving forward, let's talk about integrated reporting. This is a sophisticated approach that looks beyond just the balance sheet. It uses what we call the 6 Cs, or the 6 capitals. First, we have financial capital. This is the pool of funds available for producing goods or services, whether it's raised through debt, equity, grants, or generated through the company's own operations. Second is manufactured capital. Think of this as the human-created, production-oriented tools and equipment. This includes the physical assets available to the organization, such as buildings, machinery, and critical infrastructure like roads, ports, bridges, and water treatment plants.
Next is natural capital. This is essentially the environmental input. It includes things like water, land, minerals, forests, biodiversity, and overall ecosystem health. Then we move to human capital. This isn't just about the number of employees, but their skills, experience. Fourth, we have social capital. This is all about relationships. It refers to the institutions and networks established. Finally, we have intellectual capital. This is a key driver for future earnings. It's the synergy between R&D, innovation, and external relationships. This is often where a company finds its competitive advantage.
To wrap up this section, just keep in mind a global trend. The Asia-Pacific region currently dominates in presenting sustainability data in annual reports, with about 60% of companies reporting in 2022, and integrated reporting is particularly strong in the Middle East. Keep these capitals clear in your mind, as they are the building blocks for understanding how value is created in a modern business.
Now let's dive into the different types of capitals used in integrated reporting. This is a crucial concept for your exams because it shifts the focus from just financial numbers to a more holistic view of how a company creates value.
First, we have manufactured capital. Think of this as the physical stuff. It's everything available to the organization for producing goods or providing services. This includes your buildings, machinery, and equipment, but it also extends to larger infrastructure like roads, ports, bridges, and even water treatment plants. Next is natural capital. This is essentially the environmental input. It includes things like water, land, minerals, forests, biodiversity, and overall ecosystem health. It's important to note that an organization doesn't just use natural capital. Its activities can either positively or negatively impact these resources.
Then we move to human capital. This isn't just about the number of employees, but their skills, experience, and their drive to innovate. It covers their alignment with the company's ethical values and human rights, their ability to actually execute the organization's strategy, and their loyalty and capacity to collaborate and lead. Fourth, we have social capital. This is all about relationships. It refers to the institutions and networks established between the company and its stakeholders to enhance collective well-being. This includes shared values, the trust and loyalty built with customers and suppliers, and what we call the social license to operate, which is basically the community's acceptance of the company's presence.
Finally, we have intellectual capital. This is a key driver for future earnings. It's the synergy between R&D, innovation, and external relationships. This is often where a company finds its competitive advantage. To wrap up this section, just keep in mind the global trend. The Asia-Pacific region currently dominates in presenting sustainability data in annual reports, with about 60% of companies reporting in 2022, and integrated reporting is particularly strong in the Middle East.
All right, let's dive into this section. We start with a practical test your understanding case study involving Trustworthy Industries Limited. This is a great example of how a company can bridge the gap between voluntary frameworks and mandatory requirements. The company has been using integrated reporting, which focuses on how a company creates value over the short, medium, and long term. Even after the Business Responsibility and Sustainability Report, or BRSR, became mandatory, the company smartly used cross-referencing to avoid duplication.
Core of the question asks us to identify which capitals of integrated reporting are being referred to in two specific scenarios. First, look at point 1. The company increased its digital app users from 2 lakh to 4 lakh, leading to a 100% increase in digital collections. This is a clear reference to intellectual capital. Why? Because it involves the use of digital methods, software, and technological systems to improve business operations and customer experience.
Second, look at point 2. The company expanded its CSR beneficiaries from 10,000 to 75,000, providing sustainable livelihoods to communities. This directly relates to social and relationship capital. It's all about the value created for the community and the strength of the relationship between the company and the society it operates in.
Now, moving from the Indian context to the global scenario, let's look at the United States. In March 2022, the U.S. Securities and Exchange Commission, the SEC, proposed climate risk disclosure requirements. This is a significant move to expand annual reporting for publicly traded companies. The SEC wants companies to discuss climate-related risks that are financially material, and they are using the TCFD recommendations as a guide.
Specifically, companies would need to report on 4 key areas: their climate risk management processes, how these risks actually impact their financial performance, the strategies used to manage and mitigate those risks, and any scenario analysis, transition plans, or publicly announced climate goals they have set. It's a very structured approach to ensure that climate risk isn't just a footnote, but a core part of financial reporting.
Now, let's dive into the regulatory landscape of the United Kingdom regarding ESG disclosures. This is a crucial area for your exams, as the UK is a global leader in sustainability reporting. Starting with a big picture, the UK has a very ambitious goal. They passed a law in 2019 targeting net zero greenhouse gas emissions by the year 2050. To make this a reality, they need transparency, and that's where the Companies Act of 2006 comes in.
Now, pay close attention to who this applies to. These reporting rules aren't for every small business. They target large companies. A company is considered large if it meets any of these 3 criteria. It's listed on the stock exchange. It has an annual turnover exceeding £500 million, or it employs more than 500 people.
Historically, non-financial information wasn't always a requirement in annual reports. However, in 2022, the Act was expanded to specifically include sustainability matters. The UK has aligned these new requirements with the TCFD, the Task Force on Climate-Related Financial Disclosures. This means companies must now provide a detailed discussion on their strategy, processes, and due diligence across 5 key pillars: the environment, their employees, social matters, respect for human rights, and anti-corruption and anti-bribery measures.
When we zoom in specifically on the environment, the disclosures must be very granular. Companies need to report on climate-related risks and opportunities, how they manage those risks using targets and KPIs, how climate change is integrated into their corporate governance, and ultimately, how climate risk impacts their overall business strategy.
Beyond the Companies Act, there's another important mechanism you should know: the Streamlined Energy and Carbon Reporting, or SECR. This requires large UK companies to report their specific energy use and carbon emissions directly within their annual reports. Finally, looking forward, the UK is further formalizing this process. In 2023, the Sustainability Disclosure Requirements, known as the SDRs, were introduced. The SDRs act as a comprehensive framework, helping corporates manage sustainability-related risks and impacts while setting clear, relevant metrics and targets. Keep these UK-specific frameworks in mind, as they demonstrate the shift from voluntary reporting to a mandatory, structured regulatory environment.
Starting in early 2021, we saw a massive push in Europe. In March 2021, the Sustainable Finance Disclosures Regulation, or SFDR, went into effect. This was specifically targeted at asset managers and financial advisors in the EU to ensure transparency in how they handle sustainability risks. Shortly after, in April 2021, the European Commission proposed the CSRD, which is a game changer because it requires large companies to report on their social and environmental impact starting from 2024.
As we move through 2021, the focus shifted towards standardization. In October, the GRI standards were updated, and by November, we saw a landmark move. The IFAS Foundation announced the formation of the International Sustainability Standards Board, known as the ISB. This is a critical point for your exams because the ISB aims to create a global baseline for sustainability disclosures, much like how IFRS did for financial reporting. Around the same time, the UK's Financial Conduct Authority also released its own sustainability disclosure requirements. By December 2021, the EU continued its lead by publishing the first delegated act on sustainable activities, focusing on the first two environmental objectives within the EU territory.
Moving into 2022, the scope expanded from just reporting to actual due diligence. In February, the EU proposed a directive on corporate sustainability due diligence. This means companies aren't just reporting what happened. They are now expected to actively respect human rights and the environment across their entire global value chains. In March 2022, the momentum hit the US, with the SEC announcing a climate change disclosure proposal, and the ISP released its exposure draft for public commentary to refine those global standards. By April, the European Financial Reporting Advisory Board issued the exposure draft for the European Sustainability Reporting Standards, or ESSs. Finally, we see this becoming a truly global phenomenon. In June 2022, China introduced its own voluntary guidance for enterprise ESG disclosures.
What this timeline tells us is that we are moving away from voluntary reporting and heading toward a world of mandatory, standardized, and audited sustainability disclosures. Keep this global context in mind as we move forward.
Now, let's dive into the evolution of ESG in India. This is a crucial area for your exams, because it shows how we moved from simple voluntary charity to a structured, regulated framework of sustainability. It all started back in December 2009 when the Ministry of Corporate Affairs, or the MCA, issued the Corporate Social Responsibility Voluntary Guidelines. At that time, the goal was simple. The government wanted to encourage companies to integrate sustainability into their business practices and decision-making. These 2009 guidelines focused on the core pillars of ethical functioning, human rights, the welfare of workers, and environmental development.
By July 2011, the MCA took this a step further by introducing the National Voluntary Guidelines on Social, Environmental, and Economic Responsibilities of Business, commonly known as the NVGs. These provided a more comprehensive set of principles for companies to adopt as part of their daily business operations.
Now, this is where the regulatory landscape starts to shift from voluntary to mandatory, and that's where SEBI comes into the picture. In 2012, SEBI mandated that the top 100 listed companies, based on market capitalization, had to file a Business Responsibility Report, or BRR. This was a landmark move because it aligned corporate reporting directly with ESG principles.
By 2015, this requirement was formalized under the SEBI Listing Obligations and Disclosure Requirements, or LOTA regulations. SEBI issued a specific circular in November 2015 prescribing the exact format for the BRR. And here is a key detail for you. The scope expanded significantly during this period, as the requirement to file the Business Responsibility Report was extended to the top 500 listed companies.
First, we look at the early stages. For a while, the top 500 listed companies were required to file a Business Responsibility Report, or BRR, focusing on environmental, social, and governance parameters. Then, in February 2017, SEBI took a step forward by recommending integrated reporting, or ER, for these top 500 companies. This was initially on a voluntary basis starting from the 2017-18 financial year, encouraging companies to move beyond traditional financial statements and show how their strategy, governance, and performance create value over time. Now, moving into 2019, we see two major developments. First, the Ministry of Corporate Affairs revised the 2011 National Voluntary Guidelines to create the National Guidelines on Responsible Business Conduct, known as the NGRBC. Second, SEBI expanded the scope of the Business Responsibility Report. Starting December 26, 2019, the BRR became mandatory for the top 1,000 listed entities based on market capitalization.
The most significant shift, however, happened in May 2021. SEBI introduced a new, more comprehensive reporting requirement called the Business Responsibility and Sustainability Report, or BRSR. This is a key term for you to remember. The BRSR is designed to track a company's performance against the 9 principles of the NGRBC.
What's interesting here is how the reporting is structured. It's divided into essential and leadership indicators. The essential indicators are mandatory, you must report them. The leadership indicators are voluntary, but SEBI encourages companies to report them to show they are leading the way in sustainability. The ultimate goal of the BRSR is to move toward quantitative and standardized disclosures, which makes it much easier for stakeholders to compare ESG performance across different companies, different sectors, and over different periods of time.
Now, let's dive into the initiatives taken by the ICAI in the realm of sustainability. First, it's important to understand the goal of the Business Responsibility and Sustainability Report, or BRSR. The core objective here is to move toward quantitative and standardized disclosures on ESG parameters. Why? Because standardization is the only way we can truly compare performance across different companies, different sectors, and over different periods of time.
To lead this charge, the ICAI constituted the Sustainability Reporting Standards Board, known as the SRSB, back in February 2020. The mission of the SRSB is quite comprehensive. They want to increase awareness and implement measures for responsible business conduct, while also developing the necessary audit guidance for integrated reporting.
In fact, the ICAI has been very proactive here. Encouraged by SEBI, they introduced India's first award to celebrate the practice of integrated reporting, which is globally recognized as the gold standard for corporate reporting. To ensure professionals are well equipped, the ICAI also launched a certificate course covering sustainable development goals, business responsibility reports, and integrated reporting, along with a proposed executive development program on BRR.
Finally, let's look at the specific publications the ICAI has issued over the last 2 years to support us. First, we have SAE 3410, which provides the framework for assurance engagements on greenhouse gas statements. Then, there is the revised 2021 background material on BRSR.
And most importantly, they've released a series of guides titled Sustainable Development Goals, Accountants Creating a Sustainable World. These guides are broken down into parts, covering the various SDGs, starting from the first part which covers SDGs 1 through 5, and continuing through the subsequent parts that cover SDGs 6 to 11, and eventually spanning the entire range from SDG 1 to 17. They've also provided a set of FAQs on sustainability reporting, which they describe as the heart of good governance, and introduced the Sustainability Reporting Maturity Model, or SRMM, version 1.0.
Now let's dive into a very critical area of modern auditing and reporting: sustainable development goals and ESG assurance. As future chartered accountants, you need to understand that our role is evolving from just reporting financial numbers to helping create a sustainable world. This includes a deep understanding of the SDGs and the Sustainability Reporting Maturity Model. A major focus for your exams and professional practice is the Business Responsibility and Sustainability Report, or BRSR.
Please note the timeline here. Reporting under BRSR became mandatory starting from the financial year 2022-23, though it was voluntary for the previous year. When you look at the BRSR framework, think of it as a structured questionnaire divided into 3 distinct sections.
First, we have Section A, which covers general disclosures. This is the foundational part, where the company provides basic details about itself, its products, services, operations, employee demographics, and its corporate structure, including holdings, subsidiaries, and associates. Next is Section B, focusing on management processes and disclosures. This is where the governance part of ESG really kicks in. Here, the company explains its policies, how it manages its processes, and the level of leadership oversight involved in sustainability.
Finally, we have Section C, which is the core of the report, Principle-Wise Performance Disclosures. In this section, companies report on key performance indicators, or KPI, which are aligned with the 9 principles of the National Guidelines on Responsible Business Conduct, known as NGRBC. Now, this is a key point for your conceptual clarity. The KPIs in Section C are split into 2 categories.
First, there are essential indicators. These are mandatory disclosures. Think of these as the must-haves, such as data on energy consumption, emissions, water usage, waste management, and employee training programs. Then we have leadership indicators. These are optional disclosures. These are for companies that want to demonstrate a higher level of maturity in their sustainability journey. Examples include detailed life cycle assessments, biodiversity data, and complex supply chain management details.
BRSR framework is built around 9 core principles. To make them easier to remember, these principles are categorized into 3 pillars: environment, social, and governance, the famous ESG. Out of the 9, 2 principles fall under environment, 3 under social, and 4 under governance.
Now, while they are categorized separately, keep in mind that they are deeply interlinked. For instance, protecting the environment isn't just an ecological goal. It's closely tied to how a company engages with its stakeholders and promotes inclusive growth.
Let's focus on Principle 1, which is all about ethics, transparency, and accountability. The heart of this principle is that business decisions shouldn't be made behind closed doors. They should be open to disclosure and accessible to anyone who has a legitimate interest in the company.
There are 5 core elements you need to understand here. First, the governing structure, meaning the board and top management must develop clear policies and procedures for every office and factory to ensure that ethics are never compromised. Second, it's not enough to just have these policies. The company must actually share this information and their performance results with their stakeholders.
Third, a very important point, if there are adverse effects or negative outcomes, the company must be even more diligent and careful with their transparent disclosures. You can't hide the bad news. Fourth, the company should encourage other entities in its value chain like its partners and vendors to adopt these same principles. And finally, the entity must be proactive. If they find that outside entities they deal with, such as suppliers, distributors, subcontractors, or even regulatory officers, are violating these 9 BRSR principles, the company should respond and take a stand. Essentially, Principle 1 is about building a culture of integrity, fighting corruption, ensuring legal compliance, and being honest with stakeholders about the risks involved.
Now, let's dive into the Sustainable Development Goals and ESG assurance. We are looking at the core principles that guide how an entity should operate responsibly. You've got this. Just remember that these principles are all about moving from a purely profit-driven mindset to one that values the planet and the people.
First, let's talk about Principle 2, which focuses on safe and sustainable goods and services. The big picture here is that an entity's products and operations should actually improve the lives of the consumers and end users. There are three key pillars to this. First, right at the design stage, the entity must choose production methods and technologies that minimize resource usage. It's all about sustainability from the drawing board.
Second, it's not just about the product, it's about the person. Entities have a responsibility to educate and make their clients and consumers aware of their rights. And third, they must actively fight the overexploitation of nature. This means consuming sustainably and championing the 3Rs: reduce, reuse, and recycle.
Moving on to Principle 3, we shift our focus to the people behind the product, the employees, including those throughout the entire value chain. This principle is all about promoting well-being, dignity, and health. The entity must ensure full compliance with all employee-related regulatory requirements and, most importantly, respect the dignity of every employee as a human being. This includes respecting their freedom to form associations or unions for collective bargaining. Essentially, employees must have a voice to redress the issues they face at the workplace.
There is a zero-tolerance policy here for child labor, bonded labor, or any form of involuntary labor. Furthermore, the entity must protect the work-life balance of its staff and ensure that wages and compensation are paid on time. These wages shouldn't just be the minimum. They should be living wages that provide genuine economic security and cover basic needs.
The physical environment also matters. The workplace must be safe, hygienic, and comfortable for long-term work. Finally, the entity is responsible for the growth of its people through skill development and training, while ensuring the workplace remains completely free from harassment and violence. The physical and mental environment also matters. The entity must provide a workplace that is safe, hygienic, and comfortable for long-term work, and it must be strictly free from harassment and violence. Finally, the entity has a responsibility toward the growth of its people through skill development, career advancement, and continuous training.
First, let's look at the principle regarding employee welfare. The essence here is that an entity cannot just focus on profits. It must ensure full compliance with all regulatory requirements concerning its employees. This goes beyond just following the law. It's about respecting the dignity of the employee as a human being. This means the entity must not restrict freedom of association, unions, or any participatory mechanisms for collective bargaining. Essentially, employees must have a voice to redress the issues they face at the workplace.
Furthermore, there is a zero-tolerance policy for child labor, bonded labor, or any form of involuntary labor. The entity is also responsible for ensuring a healthy work-life balance so that employees aren't burned out. When it comes to compensation, it's not just about paying on time, but paying a living wage, one that actually covers basic needs and provides genuine economic security.
The physical and mental environment also matters. The entity must provide a workplace that is safe, hygienic, and comfortable for long-term work, and it must be strictly free from harassment and violence. Finally, the entity has a responsibility toward the growth of its people through skill development, career advancement, and continuous training.
Moving on to Principle 4, which focuses on respect for stakeholders' interests and responsiveness. You'll notice that the concept of interested parties or stakeholders is a recurring theme in almost every regulatory or voluntary management system, whether we are talking about quality, environment, or occupational health. The core elements here revolve around transparency. Entities must communicate openly with stakeholders about how their business decisions and operations impact both people and nature. There should be no ambiguity. the disclosures must be transparent and clear. To achieve this, the entity must systematically determine the context of its operations and clearly identify who its interested parties are.
And to round this out, the entity should ensure that benefits are shared fairly, providing stakeholders an opportunity to benefit from the operations in an equitable manner. Entities must ensure benefits from their operations are shared fairly and equitably among all stakeholders.
Now, let's dive into the core principles of sustainable development and ESG assurance. We are picking up with the final part of the previous discussion, which emphasizes that entities must ensure benefits from their operations are shared fairly and equitably among all stakeholders.
Moving on to Principle 5, which is all about respecting and promoting human rights. Now, human rights is a massive topic covering everything from preventing violence to stopping abusive practices. In the context of SG, we are looking at human rights issues that arise either directly or indirectly because of a business's operations. To implement this, there are 3 core elements you need to remember. First, the entity must have a deep understanding of what constitutes a human rights violation, looking at this through the lens of the Constitution of India, our national laws, and the International Bill of Human Rights.
Second, this isn't just a theoretical exercise. These human rights elements must be integrated directly into the company's actual policies, procedures, and daily practices. And third, the respect for human rights must extend beyond just the employees. It includes everyone: consumers, local communities, and especially vulnerable or marginalized groups.
Next, we have Principle 6, which focuses on the protection and restoration of the environment. The fundamental idea here is that environmental responsibility is not optional. It is a basic requirement for long-term economic prosperity and sustainability. There are several key action points here for an entity. First, they need robust policies to assess and rectify their environmental impact, and crucially, this must cover the entire life cycle of the product from raw material extraction to final disposal. Second, they must optimize the use of both natural and man-made resources, using stakeholder feedback to ensure sustainability.
Third, the entity must actually measure its performance. You can't manage what you don't measure, so they need to track pollution levels, deforestation, waste generation, and energy and land use. Fourth, they must align themselves with India's international commitments, such as the Paris Agreement and the National Action Plans for Climate Change, to build resilience against climate change.
Fifth, the entity should benchmark its activities against industry best practices, focusing on the 3 R's: reducing, reusing, and recycling or recovering materials. And finally, companies must constantly seek out new avenues and innovative ways to improve their overall performance regarding these environmental responsibilities.
First, we have Principle 7, which focuses on the influence on public and regulatory policy. Essentially, this recognizes that businesses don't operate in a vacuum. They function within the laws and policies of the governing authority. When a company tries to influence these policies, what we call policy advocacy, there are 3 key things to remember. First, the core elements of BRSR must be met holistically. Second, companies should use collective associations, like trade groups or industry chambers, to voice their concerns. And third, their advocacy must encourage fair competition and, most importantly, prevent human rights abuses.
Moving on to Principle 8. This is all about promoting inclusive growth and equitable development. This principle is about collaboration. It's not just about the company, but about working with authorities and civil associations to improve livelihoods, especially for marginalized communities. There are a few core elements here you need to be mindful of. Companies must have systems to identify how their activities impact the social, cultural, and economic lives of people. Think about things like land acquisition or the construction of new facilities. They need to review, measure, and track any adverse impacts and create action plans to mitigate them. Furthermore, they should innovate, creating products and technologies that actually improve the quality of life for marginalized groups.
When designing CSR activities, the focus should be on local and regional development priorities. Now, a very critical point here is regarding displacement. Companies must ensure that their business activities don't cause the relocation of communities. In the unavoidable cases where this does happen, they must engage in mutually agreed, participative, and informed negotiations to ensure fair compensation for the affected people. Finally, they must respect intellectual property and traditional knowledge, ensuring that any benefits derived from such knowledge are shared equitably.
All right, let's dive into the remaining parts of the BRSR principles. We are picking up with the final points of the previous section, focusing on fair compensation and intellectual property. Essentially, the framework demands that negotiations with affected people be participative and informed to ensure fair compensation. Furthermore, it emphasizes that organizations must respect all forms of intellectual property and traditional knowledge, ensuring that any benefits derived from such knowledge are shared equitably. This is all about ethics and fairness in how a company interacts with the community and creators.
Now, let's move on to Principle 9, which is a critical one, providing value to consumers in a responsible manner. At its heart, the primary purpose of any business is to provide useful products and services in exchange for reasonable profits. But responsible is the keyword here. There are several core elements you need to remember for this principle. First, entities must actively work to reduce the negative impacts of their products on the consumer, the natural environment, and society. When they are designing or marketing these products, they must not hinder fair competition or the consumer's freedom of choice.
Transparency is also huge here. Companies must accurately disclose any adverse impacts their products have on the planet, society, or biodiversity. And of course, in this digital age, maintaining the right to privacy when handling customer data is non-negotiable. Beyond the sale, the responsibility continues. When it comes to advertising, the rule is simple: no misleading or confusing information.
Beyond the sale, the responsibility continues. Entities should educate customers on the safe usage, reuse, recycling, and disposal of products to help eliminate overconsumption. To keep the relationship healthy, businesses should provide transparent and accessible grievance redressal and feedback systems so customers can actually be heard. Finally, for those providing essential services like utilities, there is a mandate to enable universal access in a non-discriminatory manner, even for those whose services may have been discontinued.
Now, let's dive into the alignment of BRSR principles with the Sustainable Development Goals, or SDG. If you look at the mapping table in your material, you'll see that the 9 BRSR principles are intricately linked to the 17 global SDGs. For instance, principles like P1 and P2 map directly to SDG 1, while other principles cover a broad spectrum of goals, including gender equality, climate action, and life below water. Essentially, this mapping ensures that when a company reports under BRSR, it is simultaneously contributing to the global agenda for sustainable development.
Moving on to a very critical area for us as professionals, assurance in BRSR. Currently, SEBI has mandated this for the top 1,000 listed companies. However, keep in mind that this is just the beginning. Very soon, the remaining listed companies will also need to comply. Why is this important for you? Because BRSR is expected to become the primary, single source for disclosing the sustainability-related information in India, this means investors, regulators, and stakeholders will rely heavily on this document for industry analysis and decision-making.
Because the stakes are so high, the need for independent assurance becomes absolutely critical. This is where the ESG audit comes into play, helping companies evaluate environmental and social risks across their products, services, and operations, while also improving supply chain transparency and risk management. Beyond the internal operations, conducting an ESG audit allows a business to scrutinize its supply chain risks, strengthen its risk management capabilities, and, most importantly, ensure transparency with its shareholders.